Remember when managing your money felt like a trip back in time? Heading to a physical branch, maybe even waiting in line sometimes, pulling out a paper checkbook or, filling out deposit slips.
Yeah, it really wasn't that long ago, was it? But it feels like a different world now.
Totally. Today, your bank isn't just nearby. It's literally in your pocket, accessible anytime, anywhere. Just a few taps on a screen. It's this huge shift.
Undeniable. It's completely revolutionized how we interact with our finances. So much convenience.
But okay, with this revolution comes this whole new language, right?
Yeah.
Sometimes it feels a bit confusing. We hear terms like digital banks, online banks, neobanks. Are they all the same thing? I mean, how are they really different from the online services my old bank offers?
That's the core question, isn't it? It's easy to get them mixed up.
Yeah, and for you listening, just trying to navigate this landscape and figure out the absolute best place to trust with your hard-earned money, it feels like there are just more options, more details, more questions than ever before.
They can feel overwhelming.
So our mission in this deep dive is basically to cut through that confusion. We've gathered a whole stack of sources, articles, research reports, all covering digital banks, neobanks, and the online stuff from traditional U.S. banks. And we're going to unpack the essential differences, the pros, the cons, and what all of this fundamentally means for your financial decisions in this constantly changing landscape.
Think of it as your guide to understanding the nuts and bolts of modern banking options.
Exactly, a shortcut maybe.
That's right. We really want to give you a clear, actionable understanding. By the end of this, you won't just know the definitions. You'll really grasp the crucial distinctions between these models. You'll understand the underlying structures that, create these differences and know what factors really matter when you're evaluating where to bank today.
Yeah, we'll go beyond just listing features.
Definitely. We're looking at everything. Fees, interest rates, obviously, but also the fundamental structure, the layers of security, and even the increasing regulatory pressures that are really shaping this space right now.
Okay, let's dive in then. To start, we really need to get our terms straight because our sources show that while people might use digital bank, online bank, and neobank kind of interchangeably in conversation.
Happens all the time.
There's actually some really important nuance hiding just beneath the surface.
Absolutely. It helps to maybe think of them along a spectrum, but with some key dividing lines. So at one end, you have your traditional banks.
The ones we all know?
Pretty much. The institutions most of us grew up with, deeply rooted in physical infrastructure. Sources like Brex and Decta really highlight this. Their defining characteristic is that physical presence. The brick-and-mortar branches you see everywhere, their own ATM networks.
Right, the big national names, or maybe your local community bank.
Exactly. And while their foundation is physical, it's really crucial to note that pretty much every traditional bank has invested heavily in tech over the last, say, decade or two. They all offer pretty comprehensive online and mobile banking now. You can do a lot digitally, even with a traditional account.
Yeah, mobile check deposit, paying bills online, transfers. It's pretty standard now.
Totally standard. They've gone digital, definitely. But their core identity, their operational model, still includes that physical footprint.
Right.
That's the key.
Okay, so traditional banks adapting, but still have the branches.
Got it. So moving along the spectrum, what about digital banks or online banks? What sets these apart? Okay, here's the first big jump. Sources like Traders Union, Genius Bank, Brex, Dacte, they're all very clear on this distinction. These institutions operate entirely online.
Entirely. So no branches whatsoever.
Zero physical branches. That's the key. No tellers to visit, no physical location you can walk into for service.
So all their services are purely virtual through an app or website.
Exactly. Access is exclusively through their websites or their mobile apps. Genius Bank, for example, which is interesting because it's a digital division of a larger chartered bank. They specifically position themselves around that deeply focused digital-first experience, making it flexible, streamlined, really designed for mobile use from the ground up.
So you can think of them as offering traditional banking services, checking, savings, maybe some loans, but just without the cost and complexity of all those physical buildings.
That's a great way to put it. Traditional services, digital delivery, no physical overhead.
Okay, that makes sense. Digital banks, traditional services, fully online.
Yep.
Now the third category, neobanks. This is where that term Fintech seems to pop up a lot.
Precisely. And this is where it gets maybe a bit more distinct and sometimes, frankly, more confusing for people.
Right.
Sources like Genius Bank, First Commonwealth, and Plaid all touch on this. Neobanks are frequently described primarily as financial technology fintech companies. Now, like digital banks, they provide financial services, managing money, payments, sometimes savings or credit features, and they do it almost exclusively through an app or online platform. They are absolutely digital first.
Okay, so digital first, like the digital banks.
Yep.
But there's a fundamental structural difference you mentioned.
Yes. And this is probably the most critical point that sources like Genius Bank and First Commonwealth really emphasize. A key difference often highlighted is that neobanks typically lack a banking charter.
No banking charter. Okay, unpack that. What does that mean?
It means they are not banks themselves. Not in the traditional, strictly regulated legal sense. Instead, they operate by relying on partnerships with existing chartered banks.
Okay, so the neobank is the slick app I use.
Right, the user-friendly interface.
But behind the scenes, my money is actually sitting in an account at a different traditional chartered bank that the neobank partners with.
That's a really good way to visualize it, yeah. They're often the technology layer, the user experience layer, built on top of the regulated financial infrastructure provided by a partner bank.
Interesting.
The sources also mention something else. Neobanks are frequently venture capital funded. Genius Bank suggests this could sometimes influence their focus, maybe prioritizing rapid customer growth over their deeply conservative, long-term stability focus you usually associate with chartered banks.
So, potentially a different business pressure.
Potentially. It doesn't mean they're inherently unstable, not at all, but their business model and their funding sources are just different from a traditional or a chartered digital bank.
Okay, so this idea of the banking charter seems absolutely foundational then. It's like the key legal dividing line.
It truly is. And that brings us really to the most important difference underpinning everything we've discussed so far. The banking charter itself.
Okay, let's unpack this properly. You mentioned the charter a few times now. What exactly is a banking charter, and why does having one, or crucially not having one, matter so much here?
Right. So a banking charter is essentially a government-issued license. It's granted by either state or federal authorities here in the U.S., and this license gives a company the legal permission to actually operate as a bank. It allows them to accept deposits from the public, make loans, and offer other specific financial services directly. The Genius Bank source explains this clearly.
And I'm guessing getting this license isn't just filling out a form.
Oh, far from it, no. Obtaining a charter is a notoriously rigorous, expensive, and lengthy approval process. Institutions applying have to demonstrate to regulators that they have substantial capital, basically, enough money to operate safely, support growth, manage risks, and, importantly, withstand potential economic shocks.
So, deep pockets and a solid plan.
Exactly. They also need to present a very clear, detailed strategic plan. It has to outline how they'll conduct business responsibly, how they'll adhere to all the regulations, and how they'll serve their customers. Genius Bank actually highlighted the extensive back and forth and planning involved when they were setting up their chartered digital bank division. It's a huge undertaking.
Okay, so it's a massive stamp of regulatory approval, signifies financial strength.
Yeah.
Why is having this charter such a fundamental advantage for the bank itself, like operationally?
Well, there are a couple of major advantages operationally and financially, according to that Genius Bank source. First, having a charter significantly lowers the cost of doing business for the bank.
How so?
Because a chartered bank can directly use the funds deposited by its customers, your checking and savings account money, to fund its lending activities, making mortgages, issuing business loans, personal loans, etc. That's the core engine of how traditional banking makes money and operates profitably.
Right, they use deposits to lend.
Precisely. Without a charter, a neobank has to rely on different, often more expensive sources of funding if they want to offer lending products themselves, or they partner for those too.
Okay, cheaper funding. What else?
Second, and this is arguably the most critical point for you, the customer, having a charter provides direct access to FDIC insurance on deposit accounts.
FDIC insurance.
Okay.
That's the big one. The government guarantee protects your money up to $250,000 per depositor per insured bank. That's the safety net everyone relies on.
It absolutely is. It's a cornerstone of public confidence in the whole banking system.
Mm-hmm.
And this is where digital banks and neobanks most significantly diverge structurally.
Explain that divergence.
Okay, so a digital bank If it is itself a chartered entity, or if it's a division of one, like Genius Bank is part of SMBC Manubank, which is chartered.
Right.
It offers that FDIC insurance directly. Your deposits are held by the actual chartered bank, and they are fully regulated and insured up to the standard limits through that charter. Sources like Traders Union, Brex, and DECTA all confirm that reputable digital banks provide this direct FDIC coverage.
But neobanks, lacking their own charter, they can't offer that insurance directly themselves.
Correct. Since they aren't the chartered bank holding the deposits, they rely entirely on their partnership with a chartered bank to offer FDIC insurance protection to their customers. Plaid, First Commonwealth, Genius Bank, they all stress this point heavily.
So what does that mean for me as a customer?
It means that while many, probably most neobanks do provide FDIC insurance coverage, it's crucial for you to understand which partner bank is actually holding your funds. And you need to explicitly confirm that your specific account is set up in a way that qualifies for what's called FDIC pass-through insurance via that partner.
Pass-through insurance.
Okay.
Plaid specifically calls this out as a necessary step for consumers. Don't just assume. Sometimes the way funds are held, maybe in different sub-accounts or through different partners for different features, can add layers of complexity you need to be aware of.
That definitely adds a layer of homework you need to do with a neobank that you probably wouldn't even think about with a traditional bank or a chartered digital bank.
It certainly can. Genius Bank also noted that relying on multiple partners for different services, including the underlying deposit accounts for FDIC coverage, can sometimes lead to a less seamless or maybe slightly disjointed customer experience compared to dealing with a single, directly chartered institution where everything's under one roof, legally speaking.
Makes sense.
Now, it is worth acknowledging, as Genius Bank and Plaid mention, that a small but growing number of neobanks do manage to evolve and obtain their own banking charters. Varo Bank is the big example they cite. They became a nationally chartered bank back in 2020.
So some are graduating. Some are, yes. But for the vast majority of neobanks you encounter today, that partnership model is how they operate.
Okay, so the charter is a fundamental structural difference. Is the institution the bank itself, or is it a tech platform built on top of a partner bank's license and infrastructure? Understanding that really changes how you look at everything else.
Absolutely.
Now that we've got our heads around that core difference, how do these distinctions actually play out in your day-to-day banking experience? Let's compare the practical realities.
Right. Let's move from the structure to the operation. How does this impact the things you actually use or care about every day? Like accessing your money, what it costs you, the services you can get?
Yeah, let's start with the most visible difference: physical presence and accessibility. Branches or no branches?
Okay. Traditional banks, as we said, they have the branches, they have large ATM networks. Brex and DECTA emphasize this is still their core model. The big pro here is obvious. Access to in-person service. If you need to deposit a big chunk of cash.
Or get rolls of quarters for laundry.
Yeah, or get change for your small business, or sit down and discuss a complicated loan application face-to-face, or access a safe deposit box, get something notarized quickly. A physical branch is invaluable for that.
That human element can be really important for complex stuff.
Definitely. Very comforting for sensitive transactions. The cons are also clear, though. Access is limited to business hours, usually 9 to 5 weekdays, maybe some limited weekend hours. And you're geographically constrained. You need to actually be near a branch or one of their specific in-network ATMs.
Right. And the digital banks and neobanks.
Yeah.
Purely online.
Purely digital, purely online. They exist solely on your devices, your computer, your smartphone. Traders Union, Brex, and DECTA highlight this as their primary strength. Accessibility is 24/7.
Anytime, anywhere.
Exactly. Manage your finances from your couch at midnight or from halfway across the world. Mobile check deposit is standard, effortless. Transferring funds, paying bills, checking balances, it's all instant, always available through the app.
The big downside is
the complete lack of in-person support. If you have a really complex issue or you just prefer talking to someone face-to-face to resolve something, that option simply doesn't exist.
And what about cash? That seems like a big hurdle.
It is the other major hurdle, yes. You can't just walk into a branch to deposit cash. Now, many digital banks and neobanks do partner with ATM networks that allow cash deposits, think Allpoint or Green Dot networks.
Okay.
Or they might integrate with services where you can deposit cash at certain retail stores, though often for a fee, but it requires extra steps. It's definitely not as seamless as just walking up to a teller window. Traders Union, Brex, and First Commonwealth all note these cash handling limitations.
Okay, so bottom line, If you regularly deal with physical cash,
Yeah.
a traditional bank still holds a pretty significant advantage there.
Clearly.
What about fees and interest rates? This feels like an area where the digital-first model should really shine, right?
Yeah.
They don't have all that overhead.
They absolutely do, and the sources consistently back this up. That core operational advantage, not having expensive physical branches, not having all the associated staff costs for those branches, translates directly into potential savings and benefits for you, the customer. Traders Union, Brex, Decta, First Commonwealth, they all highlight this connection.
So what does that look like in practice? Fewer fees?
Generally, yes. Significantly lower fees, often the complete absence of many fees that are common at traditional banks.
Like monthly maintenance fees.
Exactly. You'll typically find few or no monthly maintenance fees, even if you don't keep a high minimum balance. Often, there are no minimum balance requirements at all just to open or keep an account open. And things like transaction fees, ATM fees, they often reimburse fees from other banks' ATMs up to a certain limit. And overdraft fees can be much lower or even non-existent under certain conditions, depending on the bank.
Okay, lower fees. What about earning money?
Interest rates. And that's the other side of the coin. It's not just about paying less, it's often about earning more. Digital banks and neobanks are pretty famous for offering substantially higher interest rates, the APY, annual percentage yield on savings accounts, compared to traditional banks.
Why can they do that?
Again, it comes back to their lower operating costs. They can afford to pass more of those savings back to customers in the form of higher interest. Traders Union gives some examples. These rates change, of course, but at the time of their writing, they mentioned Varo potentially offering up to 5.00% APY under certain conditions.
Wow.
SoFi at 4.50% APY with direct deposit, Ally at 4.25%, Quantic at 4.05%, even Chime at 2.00%. While these fluctuate, they are consistently and often dramatically higher than the, frankly, near-zero rates you often see from large traditional banks on their standard savings accounts.
Okay, so the insight here seems pretty straightforward.
Yeah.
Without the massive cost of buildings and branch staff, digital-first banks can simply afford to charge you less in fees and pay you more in interest.
Exactly. It's a direct result of their structural model. It directly benefits customers who are really focused on maximizing savings and minimizing those pesky fees.
Okay. Now, what about the range of services offered? Does going digital mean you sacrifice access to certain financial products? Is it a trade-off?
Generally, yes, there can be a difference in the sheer breadth of services, although that gap is definitely closing over time.
Now,
Traditional banks are often described like comprehensive financial department stores. Brex, Decta, First Commonwealth paint this picture. Under one roof, physically or increasingly digitally now too, they offer a massive array of products. Standard checking and savings, yes, but also the really complex stuff. Mortgages, home equity lines of credit, auto loans, significant commercial loans for businesses, international wire transfers, merchant services for businesses that need to accept card payments, wealth management, private banking, the list goes on.
so if you have really complex financial needs or a business,
Right. If you need that truly comprehensive suite of complex financial products and services, a traditional bank is often just better equipped to handle all of it, and it can simplify your life by keeping everything managed in one place.
okay. And the digital-first players, what's their focus?
Digital banks tend to focus heavily on optimizing the core services, checking accounts with really slick features, and high-yield savings accounts. That's their bread and butter. Some have definitely expanded into things like personal loans or student loan refinancing. SoFi is a good example there, and many offer integrated investment platforms now, too.
And they often bundle in those money management tools, right?
Yes, that's a major area where they often excel. Sources like Traders Union, Brex, Decta, and Plaid all mention this. They integrate advanced financial management tools directly into their platforms. Think sophisticated budgeting tools, automatic categorization of your spending, automated savings rules like round up your purchases to the nearest dollar and save the change, or automatically save $10 every payday, plus real-time spending insights.
Okay, so good on the core stuff, plus helpful tech. What about neobanks specifically? Are their services even more limited sometimes?
Often they start with an even more specialized focus, yeah. Maybe initially just offering a checking account substitute, like a spending account with a debit card. However, they often compensate by packing in really innovative features that target specific consumer pain points or needs. Traders Union, First Commonwealth, and Plaid mention examples like offering early access to your direct deposit.
Oh, yeah, I've seen that advertised. Get paid 2 days early.
Exactly. Or providing limited fee-free overdraft protection, like Chime's Spot Me feature, which can cover small overdrafts up to a certain amount, maybe $200. That can be a lifesaver for some people. They might also offer tools specifically designed to help customers build or rebuild credit, like secured credit cards, Chime Credit Builder, Varo Believe Card are examples which are linked to your spending account rather than requiring a traditional credit check.
So, solving specific problems.
Right. Now, some sources like First Commonwealth do note that neobanks might need to rely on partners for services like loans, which could potentially add friction or complexity for the user. But Genius Bank points out that newer digital players are launching with a wider range of initial offerings and plan to expand aggressively based on customer feedback. So that service gap with traditional banks might not be as permanent as it once seemed.
Okay, so summing that up, traditional banks win for the full, complex suite of products. Digital and neobanks excel at the core services checking, savings, and pack-in innovative, user-centric features focused on daily money management, budgeting, and specific needs like early pay or credit building.
That's a good summary.
Now, what about the technology itself, the user experience? This has to be where digital-first models really shine, right? It's in their name.
Absolutely. This is their core competency, their main area of focus. Digital banks and neobanks are built from the ground up with a digital-first mindset. Their absolute priority is creating user-friendly, intuitive mobile apps and online platforms. Traders Union, Genius Bank, Brex, Decta, they all highlight this intense focus on the user experience, the UX.
What does that look like in practice?
They're usually very quick to adopt modern technology. They leverage AI for smarter chatbots that can actually help or offer personalized financial insights based on your spending patterns. They often use automation to speed up processing times for transfers or deposits, and features like instant transaction notifications, getting a ping on your phone the second you use your card, easy peer-to-peer payments within the app, and seamless integration with other financial or payment apps you use. That's all standard and typically executed really, really well.
And how does that compare to the tech at traditional banks? Hit or miss?
It varies much more widely among traditional banks, yeah.
Yeah.
The biggest national banks have poured billions into their tech and often offer digital platforms that can absolutely compete, feature for feature, with the dedicated online banks. Their apps can be very sophisticated.
But smaller ones might lag.
Exactly. Smaller regional or local traditional banks might significantly lag behind. You might find older apps, clunkier online interfaces. Brex and Decta note this variability. Now, traditional banks are definitely playing catch-up rapidly. They're integrating features like mobile deposit, digital payments, Zelle, etc. But Genius Bank offered a really interesting perspective on why it can be harder for them.
What was that?
They pointed out that many traditional banks are still running on core processing systems, the underlying infrastructure, that are literally 30 or 40 years old. Trying to graft cutting-edge digital features onto those ancient legacy systems is incredibly difficult, slow, and expensive.
Wow, 40-year-old tech running a bank.
It's surprisingly common, whereas newer digital banks are building on modern core systems that are only a few years old. This gives them much greater agility and capability for innovation. They can build and iterate much faster.
That makes perfect sense. It's like trying to add smart home tech to a house built in 1920 versus building a new smart home from scratch. Much easier on a new foundation.
Exactly that analogy.
Okay, now, maybe the most important question for many people. Security and reliability. With all this talk of digital platforms, partners, new tech, is your money actually safe?
It's a critical question, absolutely paramount. And the general answer is yes. Your money is typically safe with both types of reputable institutions, but the nature of the security layers and the types of risks involved can differ. Decta and Brex discuss these varying considerations.
We already established that FDIC insurance is huge, tied to the charter. That's the main safety net for deposits, right?
Mm-hmm. Absolutely. For any institution you bank with in the U.S., that FDIC insurance up to $250,000 per depositor, per insured bank, per ownership category is your primary safety net if the institution were to fail. Chartered banks, whether they're traditional banks with branches or digital banks that hold their own charter, like Genius Bank through its parent, offer this directly. Traders Union, Brex, Decta, Plaid, all confirm this is standard for chartered institutions.
But for neobanks, because they usually rely on partners, that verification step is key again.
It is absolutely key. For neobanks that lack their own charter, this is where you must do your due diligence. Plaid, Genius Bank, and First Commonwealth strongly advise you confirm explicitly that the neobank partners with an FDIC-insured bank and that your specific account and funds, as they are structured and held by that neobank, are eligible for and fully covered by that FDIC pass-through insurance.
Don't just see the FDIC logo on their website and assume you're covered.
Exactly. Understand the mechanism through the partner bank. Read the fine print on their site or in the account agreement. It should be clearly stated.
Okay, FDIC covered. What about other security, like cybersecurity?
Beyond FDIC for deposit safety, both types of institutions employ robust digital security measures. This is table stakes now. We're talking about industry standard practices like strong encryption to protect your data both in transit and at rest. Multi-factor authentication, or MFA, needing that second step like a code sent to your phone when you log in, is crucial and widely used. And they all use sophisticated fraud monitoring systems that analyze transactions in real time, looking for suspicious activity. Traders Union, Brex, and DECTA highlight these as standard across the board.
Do digital-first banks have an edge in digital security?
DECTA suggests they might sometimes be quicker to implement the very latest digital security features just because their entire focus is on the tech platform. They might be more agile in deploying new defenses.
And traditional banks still have the advantage of physical security, which digital doesn't.
Precisely. The physical security at branches vaults, secure cash handling procedures, security guards provides a layer of protection for physical assets and in-person transactions that digital-only models simply don't have. Brex and DECTA mention this as a unique benefit of the traditional model.
Okay, so both have security, just different types. But what about specific risks each model faces?
That's where things differ too. Lucinity, a source focused on financial crime, points out that digital-first models are inherently exposed to certain tech-related risks.
Such as?
Things like potential API failures. That's when different software systems need to communicate. This is especially relevant for neobanks that rely on APIs to connect with multiple third-party partners for various functions. If an API goes down, a service might break. Also, data synchronization issues between partners can cause problems. And there's always the risk of a data breach originating not at the neobank itself, but within one of the third-party systems they rely on.
So dependency on partners creates risk points.
It does. Lucinity also specifically notes that neobanks face particular challenges with digital identity verification, the KYC, or Know Your Customer processes. Because everything's remote, they sometimes struggle to detect sophisticated fraud methods like synthetic identities.
Synthetic identities, what's that?
That's where fraudsters combine real information, maybe a stolen social security number, with fake information like a made-up name and address to create a seemingly legitimate but entirely fake customer profile. It's hard to catch digitally.
Tricky. Any other neobank-specific issues mentioned?
First, Commonwealth mentions that sudden account closures, sometimes without clear immediate explanation, have been reported as an issue by some neobank customers in the past. That can obviously be very disruptive.
And traditional banks, what are their specific risks?
They face risks more associated with their physical operations, things like traditional check fraud, criminals placing card skimming devices on physical ATMs, or even internal fraud carried out by employees within the branch system. Brex highlights these types of risks.
Okay, so it's not that one is inherently more or less risky overall, but the nature of the risks they face is significantly different. Physical and internal fraud risks for traditional banks versus digital third-party integration and identity verification risks for the digital-first models.
That's a very fair summary, yes. And in both cases, reputable institutions invest heavily in security measures to mitigate their specific risks. And again, FDIC insurance remains that ultimate backstop for your deposits, provided you've confirmed its applicability, especially for neobanks.
Right. And this whole topic of risk and security ties directly in something you mentioned earlier, something critical happening right now. Increased regulatory scrutiny on these digital-first banks, especially neobanks. Sounds like that's intensifying, particularly heading into 2025.
It absolutely is. This is a really major development in the space.
So it sounds like the rapid growth and success of these digital players has really caught the full attention of regulators, and maybe the rules of the game are changing.
They absolutely have. Lucidity and Fintech Global both emphasize this point strongly. With the significant growth and market share gains we've seen from digital-first institutions globally, they mention big international names like Revolut and N26 as examples. Regulators are no longer viewing them as just small experimental startups. They are increasingly holding these institutions to the exact same stringent compliance standards as the big traditional established banks. Fintech Global explicitly states that the honeymoon period for fintechs when it comes to regulatory compliance is definitively over.
Wow. Okay. So what does that increased scrutiny actually look like in practice? Are we seeing regulators take action?
Yes, absolutely. The sources provide concrete examples from just the last year or so, 2024, heading into 2025. Regulators are taking action and issuing significant fines. For instance, in the UK, the Financial Conduct Authority, FCA, issued substantial fines related to deficiencies in anti-money laundering AML processes. 29 million to Starling Bank, which is a well-known UK neobank, and 16.7 million to Metro Bank, which is actually a traditional bank, showing the scrutiny isn't only on digital, but AML challenges are definitely highlighted for the digital players. Lucidity also mentions another prominent neobank getting hit with a 28.9 million fine in the UK for AML and sanctions screening failures.
Okay, so big fines for AML issues. Anything in the U.S.?
Yes. Here in the U.S., the Consumer Financial Protection Bureau, CFPB, fined Chime Financial $3.25 million. This was specifically related to delays in processing consumer refunds impacting customers directly.
And the rules themselves are changing too.
Yes, the regulatory landscape is actively evolving. The U.S. FDIC updated its guidance on fintech oversight in mid-2024. This is particularly impactful for neobanks operating under those banking-as-a-service or BOSS models.
Where they use a partner bank's charter.
Exactly, where they use a partner bank's charter to offer services under their own brand, sometimes called a white label model. This updated FDIC guidance, as detailed by Lucidity, places direct accountability and liability for critical compliance functions like Know Your Customer, KYC, and anti-money laundering, AML, squarely on the third-party service providers involved in those partnerships.
What does that mean practically?
It means neobanks need to ensure their tech partners are not only functional, but also fully compliant with all banking regulations. And ultimately, the neobank itself remains responsible in the eyes of the regulator for ensuring everything is done correctly. It tightens the screws on those partnership arrangements.
So the regulatory bar is definitely rising, and there are real financial consequences for failing to meet those standards, especially around preventing financial crime like money laundering. What are the specific compliance challenges this creates for these digital-first models going into 2025?
Lucidity outlines several key areas where digital-first institutions are facing significant pressure to improve. First, enhancing that digital KYC and identity verification process we talked about.
Catching the fraudsters.
Right. While digital onboarding is super convenient for legit customers, regulators want much stronger assurance that these systems can detect sophisticated fraud, like those synthetic identities, especially as these platforms scale globally and attract more attention from criminals. They need to prove their digital front door is secure. Second, just managing the sheer volume of compliance alerts generated by digital platforms. With potentially millions of users and transactions, automated transaction monitoring systems can flag a huge number of potentially suspicious activities.
But many might be false alarms.
Exactly. Lucidity notes that many older rule-based monitoring systems still in use can produce false positive rates exceeding 95%. Imagine 95 out of 100 alerts being nothing.
Wow. That sounds like trying to find a few dangerous needles in a massive haystack of false alarms. How can compliance teams possibly keep up?
It's incredibly difficult, especially since compliance teams at newer fintechs might be smaller than at a huge traditional bank. Sifting through that noise effectively to spot actual suspicious activity like complex money layering schemes or the use of money mules becomes a massive challenge.
Okay, ID verification and alert overload. What else?
A third challenge is navigating fragmented global regulations while trying to offer a consistent customer experience. As neobanks expand internationally, they have to comply with different, sometimes conflicting rules in each country. Think FDIC and CFPB rules here versus FCA rules in the UK versus EU directives. Lucidity notes a trend towards global convergence in financial crime standards, pushed by international bodies, but the specific requirements still vary, creating operational complexity.
Managing different rule books.
And finally, there are those ongoing risks stemming from their heavy reliance on technology and third-party providers. Many neobanks use external vendors for critical functions. Identity checks, transaction monitoring, payment processing, even the core banking functions through their partner banks.
Which allows them to be agile.
It allows them to scale quickly and often cost-effectively, yes, but it also introduces dependency risks. What happens if a key partner's system goes down? What if there are data sync issues between systems? What about a data breach at a vendor they use? Lucinity highlights that even in those white-label BaaS arrangements, the ultimate legal accountability for things like AML compliance and data protection still rests with the company whose name is on the app, the one interacting directly with you, the customer.
Wow, that is a really significant set of challenges. It sounds like compliance, especially around financial crime prevention, is moving rapidly from maybe a background operational task to something absolutely central to the business model and future viability of these digital-first institutions. Fintech Global really emphasized that point.
It absolutely is. It's table stakes now for survival and growth. However, it's not necessarily all downside for them.
Oh, how so?
Well, while meeting these increased compliance burdens definitely requires significant investment in resources, which could potentially stretch some smaller institutions, thin sources like Fintech Global and Lucinity also suggest something interesting. They argue that the inherent agility and the modern technological foundation of many neobanks could actually allow them to adopt advanced compliance technology faster than some traditional banks stuck with legacy systems.
Like using AI for compliance.
Exactly. Things like sophisticated AI-powered transaction monitoring systems that can learn patterns and dramatically reduce those false positives we talked about. They might be able to implement that kind of tech more quickly and effectively on a modern, flexible core system. So while the regulatory demands are high, their tech-first nature might actually provide an advantage in meeting them efficiently. Compliance is forcing them to mature, perhaps faster than they otherwise would have.
That's a fascinating dynamic. Forced evolution, maybe?
You could see it that way.
Okay, so we've covered a lot of ground. The definitions and structure, that absolutely fundamental difference of the banking charter, the practical operational contrasts in physical presence, fees, services, tech, and security. And now, this intensifying regulatory spotlight on the digital players. The big question now, for the person listening right now, is how do you take all of this information and actually make a choice? Which type of bank is right for you?
Exactly. What does this all boil down to for your personal situation? And the sources are very clear on this. There is no single best type of bank that fits everyone. The ideal choice depends entirely on your individual needs, your financial habits, and your personal preferences.
Okay, let's break down those factors the listener should really think about. First off, maybe just your basic banking habits.
Yeah, this is arguably the most practical place to start. Think about how you handle money day to day. Do you frequently deal with physical cash?
Like getting paid in tips or selling stuff locally for cash.
Exactly. Maybe you work a job where you receive tips in cash, or you sell items at markets and get paid in cash, or you often give or receive cash gifts, or maybe you run a small side business that handles physical currency. If handling cash, depositing it easily, getting change when you need it is a regular part of your financial life, then a traditional bank with its physical branches offers an invaluable level of convenience. It's just easier. Brex, Decta, and First Commonwealth all highlight this. Trying to deposit cash into a neobank account usually involves those extra steps we mentioned, finding a specific ATM, going to a retail partner, maybe paying a fee. It's just not as seamless.
Okay. But what if you're mostly cashless?
Right. On the other hand, if your financial life is largely cashless, your income arrives via direct deposit. You pay for almost everything with cards or digital wallets like Apple Pay or Google Pay. You send money to friends using peer-to-peer apps like Venmo or Zelle. Then a digital-only option's 24/7 convenience aligns perfectly with how you already operate. Brex makes this point. The lack of branches isn't a drawback if you never needed them anyway.
Okay, so cash usage is a major decision point. What about the complexity of your financial needs, beyond just checking and savings?
Yeah, consider the range of services you need now and also what you anticipate needing in the near future. Are your needs relatively simple? Primarily just a checking account for everyday spending and a savings account to stash some cash, maybe earn some decent interest?
If that's you.
If that's you, then a digital bank or a neobank could be an excellent fit. Their focus is on optimizing exactly those core services. They usually offer those high-yield savings accounts we talked about and provide really modern, useful money management tools built right in. Traders Union, Brex, Decta, First Commonwealth, Plaid, they all highlight the strength of digital-first options in these core areas.
But if you need more, like loans.
Right. However, If you anticipate needing more complex financial products, maybe all under one roof, things like applying for a mortgage soon, getting an auto loan, maybe significant personal loans, or especially if you run a business that requires commercial loans, merchant services to accept payments, or international banking capabilities, then a full-service traditional bank is typically just better equipped to handle that comprehensive suite of needs. Brex Index Day stressed this point.
So breadth of services at a traditional bank versus really optimized core services, often with innovative features at the digital neobanks. Makes sense. What about how you prefer to interact with your bank, the human element versus digital convenience?
Think about your comfort level with different support channels. Do you really value having the option to walk into a branch, sit down face-to-face with the banker, ask detailed questions, maybe build a personal relationship over time?
Some people definitely prefer that, especially for big decisions.
Absolutely. Many people find it reassuring, especially for complex financial planning or if they need help resolving a difficult issue. Traditional banks offer that personalized in-person channel. Brex and Decta discuss this value.
And the alternative.
Alternatively, are you perfectly comfortable handling all your banking interactions remotely, via phone, secure email, or maybe live chat within an app? Do you prioritize having access to support 24/7, even if it's not face-to-face, over having that physical branch option?
If so, digital is fine.
If so, digital and neobanks are designed exactly for this. They offer support channels that are always available, at least in theory. Traders Union, Brex, and Decta note this constant accessibility.
But you mentioned a caveat there, in theory.
Yeah, it's worth digging into the quality and the type of their remote support. The Traders Union expert opinion piece specifically cautions against just assuming 24/7 support, means you can instantly reach a live human agent anytime. Many digital banks rely heavily on automated chatbots first.
It can be super frustrating if your issue is complex.
Exactly. They can be great for simple questions, but maddening for nuanced problems. So it's a really good idea to read recent customer reviews specifically about their actual support responsiveness and helpfulness before you commit. Don't just rely on the marketing claims of 224/7 availability.
Good tip. Beyond those big categories, cash, service needs, interaction preference, what are the finer details people should scrutinize when comparing options?
Definitely look meticulously at the fee structure. Go beyond just the headline, no monthly service fee. Understand their policies and fees for things like overdrafts, even if they offer some protection. What happens beyond that limit? What about ATM usage? Do they charge fees for using other banks' ATMs, or do they reimburse those fees, and up to what limit? What are the fees for foreign transactions if you travel, or for sending or receiving wire transfers? Get into the details.
It's integration, user experience.
Yes. Assess how seamlessly the bank integrates with external tools you might use. Does it connect easily with payment apps like Venmo, Cash App, or Zelle? Does it sync well with budgeting software you might already use, like Mint or YNAB? Traders Union emphasizes this practical integration aspect, and definitely try to get a feel for the user experience of their app and website before fully committing. Can you find information easily? Is the app intuitive? Some offer demos, which is great. Confirm their actual customer support hours and responsiveness through recent real user reviews.
Look for perks too.
Yeah, look for value-added perks that genuinely benefit you and your lifestyle. The Traders Union expert opinion suggests this. Things like those advanced budgeting tools, automatic savings transfers, maybe cashback, or rewards programs linked to the debit card that actually align with where you spend money. Focus on features you'll actually use.
And finally, circling back one more time for neobanks specifically, because of that partnership model and the charter issue.
This is non-negotiable. You must verify explicitly and clearly that the neobank is either directly FDIC insured itself, like Varo now is, or, much more commonly, that it partners with a chartered bank that is FDIC insured. And, critically, confirm that your specific account and the funds you deposit held with them are covered by that pass-through FDIC insurance.
Where do you find that info?
Genius Bank and Plaid cannot stress this enough. This information absolutely should be prominent and easy to find on their website, usually in the footer, or clearly stated in their terms and conditions or account agreement. If you can't find it easily, that's a red flag. Don't proceed until you have that confirmation. You know, it's also valuable to just recognize the positive impact that neobanks and digital banks have had on the entire banking landscape.
How so?
As Plaid points out, their innovation, their intense focus on user experience, and their competitive pressure on fees and rates have really forced traditional banks to significantly up their own digital game.
That's true. Traditional bank apps are way better than they used to be.
Exactly. Everyone's digital offerings are better today, partly because of the competition from these newer players. That benefits all consumers, regardless of where you choose to bank.
And they've helped with financial inclusion too, right?
Yes, that's another crucial point Plaid makes. Neobanks, in particular, have played a really important role in increasing financial inclusion. They've provided accessible options, especially for individuals who might have been previously unbanked or underbanked by traditional institutions, maybe due to high fees, steep minimum balance requirements, or not having a perfect credit history. Their low-cost, easy-to-access digital models provide a vital entry point into the formal financial system for many people.
So lots of factors to weigh. It seems the best choice really is a dynamic decision. It depends on what you need right now, how your financial life actually operates day to day, and your personal preferences for interaction and the features you value most.
Yeah, that's exactly.
It requires looking beyond just the flashy marketing slogans and really understanding the underlying structure, that charter difference, and the practical realities of each model.
Precisely. Each model, traditional, digital, neobank, has its distinct strengths and its inherent limitations. There's no one-size-fits-all answer.
Well, this has been a really, really clarifying deep dive into a financial landscape that just seems to be changing faster and faster. We've journeyed through the distinct world of traditional banks, rooted in physical presence, but definitely becoming more digital. Dedicated digital banks, operating entirely online, but often chartered institutions themselves, offering that direct FDIC link. And neobanks, that innovative fintech layer, frequently built on partner banks and usually lacking their own charter, highlighting the absolute critical importance of understanding that banking license piece.
Yeah, and we've broken down how those fundamental structural differences translate into very real day-to-day operational contrasts for you. The presence or absence of physical branches and what that means for handling cash and getting certain types of service. The divergence in fees and interest rates, which is often directly driven by that difference in operational overhead. The different ranges of services available, from the comprehensive suites at traditional banks to the more specialized, feature-rich core offerings from digital players.
Right, and the varying approaches to technology and user experience, where digital often leads, but traditional banks are catching up. Plus the different layers and considerations for security and reliability, including that absolutely crucial FDIC insurance verification step you have to take with most neobanks.
And we shined a light on that increasing regulatory spotlight, didn't we? Noting how the rapid growth of these digital-first players means regulators are really holding them to account like never before, resulting in significant fines and increased demands for robust compliance, particularly around preventing financial crime.
Yeah, that compliance piece feels like a major theme going forward.
It really does. So it's clear that while digital-first banking offers undeniable convenience, potentially lower costs, and a lot of innovation that's particularly appealing if you're comfortable managing everything online, or maybe if you felt underserved by traditional options.
But traditional banks still hold significant strengths.
Absolutely. In areas like handling physical cash easily, offering those really comprehensive service suites for complex needs, and providing valuable in-person relationships for those who prefer or need that human touch. The optimal fit, as we've said, is truly a personal decision. It requires you to honestly assess your own financial life and priorities and match them to the institution's model.
Okay, so as digital-first banking continues its rapid expansion, and as it faces these increasing demands for robust compliance, better security, scalable customer support, all of which requires significant ongoing investment. Here's maybe a final thought for you, the listener, to consider as you navigate your own financial journey. Will the necessary investments these digital banks and neobanks have to make to meet these rising regulatory bars and operational demands, will that inevitably increase their own costs? And could that potentially narrow or maybe even erase over time the fee and interest rate advantages they currently enjoy over traditional banks?
That's a really interesting question. Will compliance costs push their prices up?
Yeah. And if that happens, how will this evolving balance the balance between cost, convenience, technology, and regulation? How will that ultimately shape the future of banking access, innovation, and affordability for everyone? Something to think about as you consider where your money calls home.